5 Common Investing Myths Debunked. Suggestions are something that the financial world will never run out of. You'll find all the investing advice you could ever want in this industry, no matter where you look. Unfortunately, you will encounter investing myths as well. Here are 5 common investing myths you might want to dispel to help you sort through the noise. Myth number 1. You should pay off your debt before you start investing. Investors often view debt as bad and delay making investments until all debts are paid off. Well, this isn't always the best strategy. While it is a common investing myth that building a portfolio and repaying debt are mutually exclusive activities, the truth is that doing both simultaneously can often result in a better long-term return. The trick is to think of debt repayment as an investment as well. Consider the interest rate on loans, credit card debt, and other IOUs to be the same as the return on investment. Every dollar you pay off on a student loan with a 5% interest rate is the same as earning a 5% return on that dollar in the stock market. This means that any investment that you could earn more than 5% per year would be a better use of your money than paying off your student loans. If it could earn less, paying off your student loans would be the better investment. However, it should go without saying that you should not default on your debt in order to invest. Understanding your cash flow and flexibility to pay down debt is critical. As a result, always pay at least the minimum balance on any debt you have. Once you've met the minimum, you can consider making additional payments as an investment. Myth number 2. You need to be rich to invest. One common investing myth is that only the super rich can have a stake in the stock market. According to multiple studies, more than half of all Americans invest in stocks. According to the Federal Reserve's most recent survey of consumer finances, which was released in 2019, approximately 53% of families own stock. A more recent Gallup poll conducted in April 2022 found that figure to be 58%. More than half of the working population relies on the stock market for retirement savings, far more than the richest 1% of the US population. The majority of those studies ignore the numerous pension funds that are invested in the stock market, such as the California Teachers Pension Fund, which was once one of Tesla's largest stockholders. So, why is this investing myth so prevalent? Over the last decade, it has become a rallying point for certain politicians. When politicians repeatedly declare that the stock market only benefits the wealthiest among us and are not challenged to prove their point, they create a false narrative that can be very discouraging for many people. Rather than allowing such misconceptions to hold you back, invest in your retirement gradually and with whatever you can afford. Even if it is only $100 or $50 per month to begin with, it will add up over time and help you prepare for a better future. Myth number 3. High risk always leads to higher return. One common misconception about investing is that the higher the risk, the higher the return. While there is some evidence that higher risk can lead to higher returns, there is more to generating returns than simply increasing risk. Volatility, or the degree to which the value of an investment fluctuates, is a common measure of risk in investing. A more volatile investment is one that is subject to larger swings, which can occur in either direction. So, a more volatile investment may not necessarily yield a higher return if more of its price swings are downward. Myth number 4. The more stocks or funds you own, the better diversified you are. You've almost certainly been advised to have a diversified portfolio because diversification is one method of risk mitigation. To some extent, this is correct. When you diversify your investments across a wide range of stocks, bonds, and other assets, there is less chance that a drop in any one holding will have a significant impact on your overall portfolio. The problem is that many investors have a misunderstanding of what it means to be truly diverse. Diversification is more of a character game than a numbers game. According to David Poole, Citi's head of US Consumer Wealth Management, a large number of stocks from one sector provides less diversification than a smaller group of stocks from several sectors. For example, if you own 100 technology companies, the success of one sector determines the success of your entire portfolio. A portfolio of one tech company and one financial company, on the other hand, would be more diversified because it is exposed to not one, but 2 industries. Myth number 5. You can time the market. While more level-headed investors are constantly warning against it, one of the most persistent investing myths is that you can successfully time the market. Yes, it's possible to strike it rich with a few lucky trades, but there's no way to predict what the market or even a single stock will do or when it will do it. Market timing is similar to forecasting the future. Even though there are numerous indicators of what may occur, no one can predict the future. By the way, successfully timing the market often necessitates catching lightning in a bottle not once, but twice. You must understand the ideal time to buy and the ideal time to sell. However, due to emotions, investors frequently botch both sides of the trade, entering at exorbitant prices out of excitement and selling low out of fear. So, follow the lead of institutions and professional managers. Maintain diversified assets and remain invested through ups and downs. Allow today's short-term volatility to work itself out if you're investing in a solid portfolio of solid companies. It will come full circle. It has always done so.